Hey YouTube, I'm Jimmy. In this video, I'm going to walk through my analysis of Nike, ticker symbol NKE. This is the 21st video in our series where we're analyzing all 30 companies in the Dow Jones Industrial Average. We're then going to take that analysis and build three different portfolios: a dividend, a value, and a growth portfolio. You can see a link in the description below to all the other videos. So we could break Nike's business into four main segments. Their largest is footwear. Their second largest is apparel. Next, they have something that they called other businesses. Other businesses accounts for things like Nike Golf and Converse. Now, footwear and Converse are broken out separately because technically Nike classifies Converse as a more casual footwear and they classify Nike shoes as a more athletic footwear. So they separate them for us. And then their smallest segment is called equipment. That includes things like bats, gloves, things like that. Now, when we read Nike's financial statements, well, they actually break their business into regions. So they have North America as the largest, then they have Europe, the Middle East, and Africa, then they have Asia Pacific and Latin America, and then they have the greater China area. Okay, so I just wanted to point out the way that they break out their business. Now let's look at some of their numbers and see how we can go about valuing their business. Now, I recently saw that Nike was one of the best performing stocks in 2018, so I was excited to see what their numbers look like. When we pull down revenue, we can see that their revenue has been climbing each year, which has been a pretty good thing. Next, we have net income. When we look at net income, we can see that net income has been fairly consistent, except it pulled back in 2018. Now, I think this is interesting because, like I said, Nike had a fantastic 2018, so it was interesting that net income had pulled back. Now, I also think that this is important to notice because if we remember, revenue rose in 2018 and net income fell. The only way this could happen is if net income margins fell. So when we're looking at net income margins, we can see that they did in fact fall in 2018. So what happened that made Nike one of the top performers of 2018? Well, first off, 2018 was a really bad year for stocks, but I think that a lot of the excitement about Nike has been reality versus expectations. I think that expectations have been consistently low for Nike and they've continued to outperform. And really, at the end of the day, I think that this comes down to Nike's business plan. So Nike's been undergoing what it's been calling a digital transformation. Now, just so we're on the same page, Nike's fiscal year actually ends in May. So when we say 2018 as far as revenue and earnings, that is through May. They've recently closed the second quarter. So 2019, the second half of 2018 stock performance was actually half of 2018 and half of their 2019. So as far as the digital transformation is concerned, in the third quarter of last year, Nike reported digital growth of 18%. Then in the fourth quarter, they saw 29% growth. Then in the first quarter, they saw 24% growth. And then in the fourth quarter, they reported a 41% pop in digital growth. And you may have seen this actually caused a big jump in the stock. That was about 2 weeks ago. So how do we define Nike's digital transformation? Well, Nike's trying to do a few things. First, they want to get everything into the cloud. They want to get their entire platform up in the cloud, which allows them to integrate all of the different data points that they have. So they have their SNKRS website, they have Nike Plus, they have a few Nike Plus apps, they have a running app, they have training apps, they have their social media platforms, everything. They want to take all of that data, push it together, and use it to truly study the customer. The more they study, in theory, the better they'll be able to sell more specifically, more customized to the customer. The other thing this has done for Nike is to assist them in their marketing. So instead of paying for advertising spots or sponsorships, or really in addition to advertising and sponsorships, what they do is by pushing their stuff through their digital platform, they allow some of the top influencers on the internet to push their gear for them. Now, this works out very well because it both saves them some advertising costs and helps push their products to the right customer. Now, all this may be great from a digital perspective when it comes to building Nike's brand, but what will it do for revenue and profits? So this is where it gets interesting. One of the reasons to go digital is to be able to go direct to consumer. Margins are much better if you don't have to sell to a distributor first. Along those same lines, in the middle of 2018, Nike bought a tech startup called Virgin Mega, which helps them with their user experience, specifically in apps. Now, right before that purchase, Nike bought something called Zodiac. Zodiac is a data analytics firm, and I think that all of those acquisitions and everything Nike is doing is heading in the right direction as far as making a positive digital shift. Now, their digital transformation isn't the only thing happening with Nike, although I do think that's great and has the potential to give them a competitive advantage over some of their peers. So before we get into valuing Nike stock, let's look more broadly at the business. One interesting point that I noticed when I was doing my research is that they're revamping their production process. And they recently invested in an assembly process change that essentially cuts their labor in half and cuts the steps to manufacture a shoe by about a third. Now, once again, all of this gears towards improving Nike's margins over the long run, which we recently saw had a pullback. So if they could pull that off over the next few years, I would expect their margins to get better. Now, there's something else to keep in mind. Nike's a global company. And as is true with pretty much any global company, currency risk is something that we should pay attention to. Although currency will usually be adjusted in the earnings, the company will usually come out and adjust it for you. But I bring this out because in the most recent quarterly report, I was reading about it, and Nike came out and said that they had increased their revenue by 10%. Then they went on to say that 10% was actually a 14% increase, but their revenue, the currency adjustments, shifted it down from 14% to 10%. Now, just so we're all on the same page, this is a chart of the US dollar in Nike's second quarter. And as we could see, the dollar got stronger through the quarter. And what this means for us is that all the money that Nike earned overseas, all the revenue that came in, well, that revenue has to be adjusted back into US dollars. Because US dollars are getting more expensive, they need more revenue to get to the same amount of dollar number. So that explains the difference between 14% is what revenue grew overseas, but then when they brought it back, they actually gave up 4% because the dollar was getting stronger. Now, as I said, this is adjusted from quarter to quarter or year to year, but I just mention it so we can keep it in the back of our minds, because if we ever see the dollar going crazy or falling off a cliff, well, either way, we know that will affect both revenue and earnings. So it's just something to keep in the back of our mind. Okay, now we're going to jump over to valuation. And right after that, I actually want to touch on something that I like to do to help monitor a company to see if we think that company is when is a good time to sell. And I like to do it when I'm first setting up to add a company to my portfolio. So I'll bring that out in a second. So for valuation, I think we can use a price to earnings ratio. Now, typically I like to use discounted cash flow, but I think PE works well here, and it's a popular valuation tool to use. Plus, it sort of ties into the part that I mentioned about when to sell a stock. So we'll come back to that in a second. So for now, let's look at Nike's own PE multiples. Well, their current PE is about 25x. This is their forward PE. And when we look at their 1-year average, it's about 27x, and both their 3 and 5-year averages are 21x. Now, when we look at some peers, something like Under Armour, well, Under Armour is trading at 61x. Now, that's a little bit tricky because they're just a little bit profitable, at least on a forward PE basis. So that might not be the best one to use from a valuation perspective. If I were analyzing Under Armour, I wouldn't be using PE. Then if we jump to Adidas, well, their forward PE is about 22x. Now, I actually think that Nike should be trading at a premium to Adidas, and that's mostly because in some of the economies that they both compete in, specifically Western Europe, well, Adidas has struggled where Nike has really continued to do well. That was some of the headwinds that analysts expected in the most recent quarter, and Nike outperformed there. One of the reasons I think the stock jumped, at least initially. Plus, I think that Nike's long-term plan when it comes to improving margins and improving the digital platform allows for them to be trading at a premium. So let's say we're going to stick with the 1-year average of 27x. Well, if we apply 27x to their anticipated earnings per share of $2.88 over the next 4 quarters, well, we would end up with a fair value of about $78 per share. Right now, the stock is trading at about $74 per share, which for me means that it's pretty close to being fairly valued. Okay, so I like Nike from a growth perspective. I like where they're going. I think that it has the potential to get better and better from a growth story. From a value story, probably not as much. But let's pretend the stock fell and we got involved. Or pretend that we buy it for a growth perspective. How do we know whether or not the stock is playing out well for us? And when do we get out? So personally, I like to put something like this together. Now, this is quarterly estimates going out the next few years. I usually like to add annual, but we'll just look at the quarterly for now. Q1 and Q2 of 2019 are already in. That's why they're in red or orange or whatever color that is. Now, I think this is important because analyst estimates are notorious for changing. Analysts are always changing their mind based on what just happened, and that could be a good thing. But when we get into a stock, we're getting into it because we believe this or something like this will happen from an earnings per share perspective. Okay, now if we switch this table to a chart, well, this is what our expected earnings per share would look like from a chart perspective. Now, what if I told you that the stock, Nike stock, did this through 2020? And let's also imagine that earnings per share came out exactly as we predicted. It wouldn't, but let's pretend it was close. Well, I bring this up because I actually think that the price of the stock is somewhat unimportant in this whole thing. The fact that the stock has fallen, in my opinion, should be secondary to what's actually happening with the company itself. And I think the same thing could be true at the portfolio level. So let's imagine that we own 500 shares of Nike stock. And since we're owners of the company, we could, in theory, take their earnings per share and apply it to our own business or our portfolio. So if we own 500 shares of Nike and they were to earn, let's say next quarter, they were going to earn 67 cents per share. Well, that would mean that our portfolio had earnings of $335. That's the 500 shares times 67 cents. Now, let's imagine that we own two other companies in there. We own ABC and XYZ. Well, we have 50 shares of ABC, and they're expected to earn $4.58 per share. So this could be an additional $229 in earnings to our portfolio. Then XYZ is supposed to earn $2.18 per share. We have 200 shares, so that would bring in another $436 for our portfolio. So our goal is to consistently increase the value of our portfolio each and every year. This is similar to what Warren Buffett does with Berkshire Hathaway. So when we look at it like this, the price we pay impacts the number of shares we could buy, nothing more. The price of the stock doesn't at all affect our earnings per share. And frankly, quarterly is probably a bit short-sighted. It makes more sense. I like it better to look at it from an annual perspective. But then either way, the concept remains the same. If we look at our portfolio as a way to generate income and not necessarily dividends, dividends are a part of it and that gets incorporated into it. But it's also, what does the earnings per share, how do they apply to our particular shares? So if we were to jump in and we were to buy Nike and Nike were to consistently come up just short on all of their earnings per share, and each year, what we thought, let's say we projected out the next 5 years on an annual basis, and each year we had to reduce what those earnings would be. Well, when we're researching another company, we might find another company that has better value that would produce more earnings per share for our portfolio. That being said, I think that it makes sense to shift our perspective to look at a portfolio as a business and then to acquire other pieces of the business. For me, that's how I like to look at every individual holding. Now, going back to Nike's valuation, I actually think that Nike's pretty fairly valued right here. From a dividend portfolio perspective, I don't think it would make sense there because Nike's dividend is just a bit over 1%. Their dividend yield just a bit over 1%. From a value perspective, like I said, we're calculating about a $78 valuation. I actually did discounted cash flow. I don't have the numbers up here, but it was slightly above that. I'd like to see it in the 60s if we're going to buy it from a value perspective, but that's just me. From a growth perspective, it might make sense. I actually think that they have a good chance of outperforming our projected earnings per share. So from a portfolio perspective, as we just pointed out, as I just sort of illustrated, I think it might make sense to add it to the growth portfolio if we think that they can outperform in the earnings per share perspective. But what do you think? Do you think that Nike belongs in any of our portfolios? Let me know what you think in the comments below. If you haven't done so already, hit the subscribe button. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.